By the end of this video, you'll discover the 12 investing mistakes Warren Buffett has spent decades warning people about. Mistakes that silently keep millions of hard-working people poor, even when they earn good money, save consistently, and believe they're investing the right way. The shocking part is, most of these mistakes don't look like mistakes at all. Some are taught as good financial advice. Some are recommended by friends. Some are celebrated across social media every single day. But together, they quietly steal hundreds of thousands of dollars from your future. And here's why you should keep watching. If you're making even one of these 12 mistakes today, it could cost you more than the next market crash ever will. Because Warren Buffett didn't become one of the greatest investors in history by finding secret stocks. He became wealthy by avoiding the mistakes everyone else kept repeating. So as you watch, don't ask yourself, do other people do this? Ask, am I making this mistake? Because one honest answer today could completely change your financial future. Let's begin with the first mistake, the one Warren Buffett believes almost every new investor makes before buying their very first investment. What if the biggest mistake you're making with money has nothing to do with choosing the wrong stock? What if the real reason millions of people never build wealth is because they keep repeating the same invisible mistakes year after year without ever realizing it? Here's the shocking part. Warren Buffett, one of the greatest investors in history, has spent over 70 years watching ordinary people make the exact same financial decisions. And according to him, those decisions don't just cost thousands of dollars. They quietly destroy entire lifetimes of wealth. Today, you're about to discover the 12 investing mistakes that keep intelligent people working harder, saving more, and still falling behind. Some of these mistakes look completely harmless. One is taught in schools. Another is recommended by friends. One mistake is even celebrated on social media. But together, they create a financial life where your salary keeps growing, yet your freedom never does. And here's why this matters. If you avoid just one of these mistakes, your future could look completely different. Because investing isn't about finding the perfect stock. It's about avoiding the decisions that quietly make you poorer every single year. Warren Buffett once said, "Risk comes from not knowing what you're doing." Most people think he was talking about the stock market. He wasn't. He was talking about behavior. Because the biggest enemy of your investments isn't inflation. It isn't recessions. It isn't even market crashes. It's you. Your emotions. Your habits. Your impatience. And over the next 20 minutes, you're going to see how each one can silently steal millions from your future. But before we begin, I want to challenge you. As each mistake appears, don't ask, do other people do this? Ask yourself, am I doing this? Because the people who become wealthy aren't the ones who know the most. They're the ones willing to recognize their own mistakes before the market does. And I promise you, at least one of the 12 mistakes you're about to see is probably affecting you right now. Let's begin with the mistake that Warren Buffett believes almost everyone makes before they ever buy their first investment. Part 2, Mistake Number 1, Investing Without Understanding. Warren Buffett once said, "Never invest in a business you cannot understand." Simple. Yet, it's probably the most ignored investing advice ever given. Today, millions of people buy stocks the same way they buy shoes. Someone on YouTube recommends it. A friend says, "It's going to the moon." A headline says, "This company could be the next Apple." And suddenly, money starts moving. Not because people understand what they're buying, because they don't want to miss out. This is called FOMO. Fear of missing out. And it's one of the most expensive emotions an investor can have. Imagine walking into a car dealership. You know nothing about engines, nothing about safety, nothing about reliability. Yet someone says, "This one's amazing. Would you spend $50,000 without asking questions?" Probably not. Then why do people buy businesses they know absolutely nothing about? Because when money is involved, logic often disappears, and emotion takes control. This is exactly what happened during the dot-com bubble. Companies with almost no profits saw their stock prices explode. Everyone believed they had discovered easy money. Taxi drivers, students, teachers, even people who had never invested before started buying because everyone else was buying. Then the bubble burst. Billions of dollars vanished. Not because investing was bad, because people invested without understanding what they owned. Charlie Munger once said, "Knowing what you don't know is more useful than being brilliant." Think about that. Successful investing isn't about pretending to know everything. It's about admitting when you don't. Because every investment is really a business. When you buy one share, you're buying a tiny piece of an actual company. So here's a question. If someone offered you the chance to buy an entire business, would you spend 1 hour researching it? Or would you buy it after watching a 60-second TikTok? Sounds ridiculous. Yet people do it every single day. Here's something most beginners never ask. How does this company actually make money? Who are its competitors? Can it survive the next recession? Does it have real profits? Or just big promises? Warren Buffett spends weeks, sometimes months, studying businesses before investing. Most beginners spend less time than choosing a Netflix movie. That's the difference. One buys ownership. The other buys excitement. And excitement isn't an investment strategy. It's entertainment. So before we move to the next mistake, I want you to pause for a moment. Think about every investment you currently own. Now ask yourself, could I explain how this business makes money to a 12-year-old? If the answer is no, then maybe you're not investing. Maybe you're just hoping. And hope has never been a successful investment strategy, because the market has a brutal habit of exposing what people pretend to understand. And that leads us to Warren Buffett's second warning. A mistake that looks smart, feels safe, and quietly destroys more wealth than almost anything else. Part 3, mistake number 2, chasing what everyone else is buying. Imagine walking into a room where everyone is running toward one single door. Nobody knows what's behind it. But because everyone else is running, you start running too. That's human nature. And it's exactly how bubbles begin. Warren Buffett has spent decades doing something most investors find almost impossible. He thinks independently. He once said, "Be fearful when others are greedy, and greedy when others are fearful." At first, that sounds simple. Until real money is involved. Because when markets are exploding upward, every headline, every influencer, every friend makes you feel like you're being left behind. You open social media, and someone claims they doubled their money. Another says they became financially free from one stock. Someone else posts screenshots of massive profits. Your brain starts whispering, "Why not me?" This isn't logic. It's psychology. Scientists call it social proof. When we don't know what to do, our brains naturally copy the crowd. Thousands of years ago, this instinct kept humans alive. If everyone ran, you ran too, because staying behind could mean death. Today, the same survival instinct makes people buy at the highest prices and panic at the lowest. The crowd rarely creates wealth. It usually creates volatility. Look back at almost every financial bubble. The dot-com bubble, the housing bubble, cryptocurrency hype, meme stocks, different assets. Same psychology. People weren't buying because they understood value. They were buying because everyone else already had. By the time the average person hears about that next big opportunity, someone else has usually been investing for months or even years. You're not early. You're becoming their exit liquidity. That's the uncomfortable truth. Warren Buffett doesn't invest when excitement is highest. He invests when value is highest. Those two moments are rarely the same. Imagine walking into a luxury store. Yesterday, everything cost $100. Today, the exact same items cost $500. Would you celebrate? Of course not. You'd wait. But in the stock market, people do the opposite. The higher prices go, the more excited they become. The cheaper prices become, the more afraid they get. It's completely backwards. Successful investors don't ask, "What is everyone buying?" They ask, "What is everyone ignoring?" Because that's often where opportunity begins. Here's a challenge. The next time you feel excited about buying something, simply because everyone is talking about it, stop. Ask yourself, if nobody else was buying this today, would I still want it? That one question can save you from years of regret. Because markets reward patience, not popularity. And Warren Buffett built one of the greatest fortunes in history by refusing to follow crowds. Unfortunately, most investors make an even bigger mistake, one that destroys wealth, even when they've chosen the right investment. Part 4, mistake number 3, selling the moment the market falls. Imagine this. You buy a business that you truly believe in. You research it. You understand it. You know it has a strong future. Then, one morning, you wake up And it's worth 20% less. How do you feel? For most people, the answer is immediate. Fear, panic, regret. And that's exactly when the biggest mistake happens. They sell, not because the business changed, because their emotions did. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Read that again. Not from the poor to the rich. Not from the weak to the strong. From the impatient to the patient. The market doesn't just test your knowledge. It tests your emotions. Think back to March 2020. The world shut down. Markets crashed. Headlines screamed, "The economy is collapsing." Millions of investors did exactly what fear told them to do. They sold. Some sold their retirement savings. Some sold after investing for decades. They believed they were protecting themselves. But a few months later, something remarkable happened. The market recovered. Then it reached new all-time highs. The people who sold in fear locked in their losses. The people who stayed calm were rewarded. The difference wasn't intelligence. It was emotional control. Here's something that surprises most beginners. Market crashes are normal, not rare. Normal. Since the beginning of modern investing, the stock market has experienced wars, recessions, financial crises, pandemics, political uncertainty, and countless crashes. Yet over the long term, it has continued to grow because businesses continue creating value. But human emotions don't remember history. They react to headlines. Behavioral psychologists call this loss aversion. Research shows the pain of losing $100 feels almost twice as powerful as the joy of gaining $100. That's why investors panic. Not because the market became irrational. Because their brain did. Here's how Warren Buffett looks at it. He imagines the stock market as a business partner named Mr. Market. Every day, Mr. Market offers to buy or sell his shares. Some days, Mr. Market is optimistic. Other days, he's terrified. But Buffett never lets Mr. Market's mood control his decisions. He simply asks, is the business still worth owning? If the answer is yes, then falling prices aren't bad news. They're discounts. Imagine your favorite luxury watch going on sale for 40% off. Would you panic? Or would you smile? Yet when great companies go on sale, most investors run away because prices feel different when emotions are involved. Here's a challenge. The next time the market falls, don't ask, "How much money have I lost?" Ask instead, "Has the business changed?" Or only, "The price?" Because prices move every day. Value moves much slower. And investors who confuse price with value usually end up selling their future at the worst possible moment. Which brings us to Buffett's fourth warning. A mistake that doesn't happen during market crashes. It happens during market booms. And it's responsible for creating some of the biggest financial disasters in history. Part 5, Mistake number 4, confusing a great company with a great investment. Here's a question that almost nobody asks. Can a great company still be a terrible investment? The answer is yes. In fact, some of the best companies in the world have produced disappointing returns for investors, not because the businesses were bad, because people paid far too much to own them. This is one of Warren Buffett's most important lessons. He once said, "Price is what you pay. Value is what you get." Most beginners only see the company. They never look at the price. Imagine someone offers you a bottle of water. Normally, it costs $1. Would you buy it for $50? Of course not. The product didn't change. The price did. Now replace that bottle of water with a famous company. Apple, Nvidia, Microsoft, Amazon. Amazing businesses. But here's what most investors forget. Even an incredible business can become a bad investment if you pay too much for it. This mistake usually happens during bull markets. Everyone becomes excited. Headlines say, "This company will dominate the future." Analysts raise their price targets. Social media fills with success stories. People stop asking, "What is it worth?" and start asking, "What if it doubles?" That's greed, not investing. Benjamin Graham, the man who taught Warren Buffett, introduced one of the most powerful ideas in investing: the margin of safety. The idea is simple. Never buy with zero room for mistakes, because the future is unpredictable. Even great companies can have bad years. New competitors appear. Technology changes. Consumer behavior shifts. The unexpected always happens. Buying with a margin of safety protects you when life doesn't go according to plan. Here's a simple example. Imagine two investors both buy the exact same company. The first buys it when it's massively overvalued. The second waits patiently until fear pushes the price down. 5 years later, the business performs almost identically. Yet one investor makes outstanding returns. The other barely breaks even. Same company, different price, completely different outcome. This is why Warren Buffett is famous for doing nothing. Sometimes for months. Sometimes for years. Because patience is part of the investment. He isn't waiting for a miracle. He's waiting for the right price. Most people can't do that because modern life trains us to believe that doing something is always better than doing nothing. But investing doesn't reward constant action. It rewards correct action. Charlie Munger once joked, "The big money is not in the buying or selling, but in the waiting." That sentence has created more millionaires than most investing books. Because wealth doesn't grow every time you click the buy button. It grows while time does the work. So before you buy your next investment, don't just ask, "Is this a great company?" Ask, "Am I paying a great price?" Because even the world's greatest business can become a terrible investment if your emotions convince you that any price is worth paying. And that leads us to Buffett's fifth warning. A mistake that sounds responsible, looks intelligent, and secretly keeps millions of people poor for decades. Part 6, Mistake number 5, Waiting for the perfect time to invest. Imagine someone offered you the opportunity to plant the world's most valuable tree. The only condition was simple. The sooner you planted it, the bigger it would become. Would you wait for the perfect weather? The perfect season? The perfect mood? Probably not. You'd plant it today. Yet when it comes to investing, Millions of people spend years waiting for the market to crash, waiting for interest rates to fall, waiting for elections to end, waiting for the economy to become safe. They call it being careful. Warren Buffett calls it missing opportunity. One of his most famous quotes is, "Time in the market beats timing the market." Notice what he didn't say. He didn't say, buy recklessly. He didn't say, ignore valuations. He simply understood one powerful truth. Nobody can consistently predict what markets will do tomorrow. Not economists, not billionaires, not television experts, and certainly not the people posting predictions on social media. Yet every year, millions of investors believe they'll be different. They tell themselves, "I'll invest after the next correction. The market feels too expensive. I'll wait until things calm down." Months pass, then years. The money stays in the bank. Inflation quietly reduces its purchasing power. And the greatest investor they never invested in was time itself. Here's something fascinating. If you missed just a handful of the market's best performing days, your long-term returns would fall dramatically. The problem is, those best days often happen immediately after the worst days. The investors who panic and leave the market usually miss the recovery too. That's why trying to predict every market movement isn't just difficult. It's almost impossible. Let's imagine two friends both decide to build wealth. The first starts investing today, small amounts, every month, consistently. The second says, "I'll wait for the perfect opportunity." 5 years later, the first investor has experienced market crashes, bad news, good news, and steady compounding. The second is still waiting for certainty. One owns assets. The other owns excuses. Because certainty almost never arrives before opportunity disappears. Morgan Housel writes that the highest returns often belong to people who simply stayed invested long enough to let compounding do its job, not because they were smarter, because they were patient. Here's a question very few people ask. What is the cost of doing nothing? Most people worry about losing money by investing. Almost nobody worries about losing wealth by waiting. But waiting has a price too. A price that compounds silently. Every year you delay investing is one less year your money can work for you. And unlike a market loss, you can never recover lost time, because time is the only asset that even billionaires cannot buy back. So before you tell yourself, "I'll start next year," remember this: the perfect time has never existed. The investors who built fortunes weren't the ones who found the perfect moment. They were the ones who started before they felt ready and stayed consistent long after everyone else gave up. And that brings us to Buffett's sixth warning: a mistake that feels incredibly safe, but quietly guarantees average results for the rest of your life. Mistake number 6: trying to get rich quick. If someone promises you quick wealth, they're usually trying to get rich using you. Warren Buffett never became a billionaire overnight. He became one by letting time do the heavy lifting. Yet today, people want 10x returns in 10 weeks. They chase the hottest stock, the newest cryptocurrency, the latest can't-miss opportunity. Why? Because patience doesn't go viral. Fast money does. This is exactly what scammers and market bubbles depend on. They don't sell investments. They sell excitement. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Read that carefully. Not from the poor to the rich. From the impatient to the patient. Every time you jump from one investment to another, looking for the next big winner, you're resetting your biggest advantage: time. The greatest fortunes weren't built through lucky trades. They were built through consistent ownership of great businesses. Ask yourself, are you investing to become wealthy? Or are you simply looking for excitement? Because the market rewards discipline, not dopamine. Mistake number 7: thinking diversification means buying everything. One of the biggest myths in investing is that more investments mean less risk. Not always. Some people own 50 different stocks, multiple mutual funds, several ETFs, crypto, gold, real estate, and somehow they still don't know what they actually own. That's not diversification. That's confusion. Warren Buffett once said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. Notice, he didn't say, diversification is bad. He said, blind diversification is because if you buy everything, you'll perform. And average investing creates average wealth. Buffett made most of his fortune by concentrating on businesses he deeply understood. Quality always beats quantity. Here's a simple question. Would you rather own 5 exceptional businesses that you've researched for hundreds of hours, or 50 companies whose names you can barely pronounce? Most beginners mistake activity for intelligence. They believe more investments mean they're smarter. But successful investing isn't about collecting stocks. It's about owning great businesses. Remember, you don't need 100 opportunities to become wealthy. Sometimes one exceptional investment held for decades can change your entire financial future. Mistake number 8, investing with emotions instead of logic. The market doesn't care how you feel. It doesn't know you're scared. It doesn't know you're excited. Yet every day, millions of investors make decisions based entirely on emotions. When prices rise, they become greedy. When prices fall, they become afraid. Warren Buffett does the exact opposite. He once said, "Be fearful when others are greedy, and greedy when others are fearful." That's easier to read than to live. Because your brain is wired to follow the crowd. When everyone is buying, you feel safe buying too. When everyone is selling, panic feels logical. But history proves the crowd is usually wrong. At the extremes, successful investors don't react to headlines. They react to value. If your investment thesis hasn't changed, why should your emotions change your decision? Remember, your portfolio should be managed by a plan, not by your mood. Mistake number 9, ignoring the power of compounding. Most people dramatically overestimate what they can earn in 1 year and completely underestimate what they can build in 20. That's why they quit too early. Compounding looks boring at first. For years, almost nothing happens. Then suddenly, everything happens. Warren Buffett earned most of his wealth after the age of 50. Not because he suddenly became smarter, because compounding had enough time to work. Imagine planting an oak tree. You don't dig it up every 6 months to check if it's growing. You trust the process. Investing works the same way. The people who become wealthy aren't always the highest earners. They're usually the ones who stayed invested the longest. Time is the greatest multiplier money has. Mistake number 10, never learning from your losses. Every investor will make mistakes. Even Warren Buffett has made multi-billion-dollar mistakes. The difference is he studies them. Most people try to forget them. They blame the market, the economy, the government, anyone except themselves. But every loss contains an expensive lesson. And if you don't learn it, you'll pay for it again. Charlie Munger once said, "The wise learn from their mistakes. The wiser learn from others' mistakes." After every investment, ask yourself, what did this teach me? Not, how quickly can I recover? Because losing money is painful, but learning nothing is far more expensive. The market is the greatest teacher in the world. The only question is, are you paying tuition or earning wisdom?